All right, welcome everyone. This is the one you've been waiting for. We are pulling back the curtain and revealing our complete blueprint to escape portfolio for December 2025. We're going to walk you through the whole shebang, every single holding, what it's yielding right now, and maybe most importantly, our 5-point game plan for January 2026. And of course, we'll get into the why behind it all, our core philosophy. So let's dive right in. Okay, first things first, we've got to get the legal stuff out of the way. Just a quick reminder that this is all for educational and entertainment purposes. It is absolutely not financial, tax, or investment advice. And just to be crystal clear, none of the companies or ETFs we talk about are sponsors. It is so important that you do your own homework to see if any of these ideas actually make sense for your personal situation. Look, we put a ton of our own research and knowledge into this, but at the end of the day, your financial journey is yours alone. Always make your decisions based on your own goals and what you're comfortable with. Okay, disclaimers are out of the way, so let's get to the good stuff, the number you're all here to see. As of mid-December 2025, our portfolio is kicking off a 13.5% yield. Now, that's a pretty solid number, right? But for us, it's really just the starting point. It's the baseline we're going to build on and make even better next month. So the big question is, how do we get to a number like that? Well, let's crack this thing open and take a look at the actual holdings, breaking it down between our Canadian and US positions. So from a bird's eye view, here's the split. It's about 80% Canadian holdings and 20% in the US. Now, this isn't random. It's a strategic choice. We keep the bulk of it in Canadian accounts like our TFSA to really maximize those tax advantages, while the US portion sits in our RRSP. It's all about being as tax efficient as possible. All right, let's dig into the Canadian side first. You'll see right away that the heart and soul of our income generation comes from these high-yield covered call ETFs at the top. HDIV, for instance, is our biggest single position, sitting at 15%. As you go down the list, you'll see the weights get smaller. That's by design. It's how we spread our bets across different sectors and strategies. Now, let's hop over to our US holdings. This part of the portfolio has a kind of dual personality. It's built for both income and for long-term growth. That's why the position sizes are a bit smaller, usually around 2% each. We're going for a broader diversification here. And you might notice Google in there with a 0% yield. You might be thinking, what's that doing in an income portfolio? Well, that's a pure growth play. We're not looking for income from it, we're betting on its long-term potential for capital growth. You know, a portfolio is never really done. It's a living, breathing thing that needs fine-tuning. So as we look ahead to January 2026, we've already mapped out 5 key moves we're going to make to optimize and strengthen what we've got. So here's the game plan for January, broken down into 5 key moves. First up, we're managing risk. That HBTE position, it's been a bit of a roller coaster, so we're trimming it from 9% down to less than 5%. Got to reduce that volatility. Second, we're showing more conviction in our smaller plays. We're bumping them up to at least 2% each. Yeah, I'm looking at you, Google. Third, it's time for a checkup on our US dollar ETFs. Fourth, a classic rebalance. We're going to even out the weights of our core Canadian ETFs. And fifth, we're thinking about defense. We're going to explore adding some more stable sectors, like healthcare or maybe some REITs to shore things up. Okay, so for anyone who's new here, or even if you just need a refresher, I want to take a second to talk about the why behind all these moves. This is the foundation, our core investment philosophy that guides every single decision we make. This is our golden rule. Rule number 1, above absolutely everything else, is to protect our capital. Before we even dream about gains, we're obsessed with not losing our initial investment. Because let's be real, you can't build sustainable income if your starting capital disappears. And that one rule really shapes everything else we do. We focus on assets that are designed to generate income, like these covered call ETFs. We reinvest every single penny of that income to get the magic of compounding working for us. We don't try to be heroes and time the market. Instead, we just aim to build a portfolio that can handle whatever comes its way. And a huge part of that is balance, making sure no single holding ever gets bigger than 15%. That way, one bad apple can't ruin the whole bunch. This actually brings up a really interesting idea we call worsification. It's this trap you can fall into where you own too many things. You think you're being safer, but you're actually just diluting your focus and your potential returns. For what we're trying to do here, we found the sweet spot is somewhere between 20 and 25 holdings. It's enough to be diversified and safe, but focused enough that we actually know what we own.
It's also so important to look beyond that big, flashy yield number. We're focused on total return. That's the income plus any growth in the price. And that means we accept a trade-off. We might not capture all of the upside in a screaming bull market, but in exchange, we get better protection on the downside. And you gotta remember, there's no free lunch. A super high yield can sometimes be a warning sign for something called NAV erosion, which is basically the fund just giving you your own money back. Not good. This might just be the most critical piece of the whole puzzle. The market is just a giant machine designed to mess with your emotions. Our entire approach is to tune out the noise, invest based on research and conviction, and stick to our plan. You have to stay stoic and avoid those knee-jerk reactions. And look, at the end of the day, this is about making a strategy that works for you. We're comfortable in areas like tech and financials, so that's where we focus. But maybe you know everything about the energy sector or real estate. Perfect. The key is to invest in what you understand, build a portfolio that matches your age and your goals, and then use the right tools like your TFSA and RRSP to make it as efficient as possible.
We really believe in being totally transparent, which is a big reason why we share all of this with you. And we'd love for you to join us and follow along on this journey, month after month. You can count on a full portfolio update just like this one every single month, right around the 20th. That timing just works well for us as we get ready for the next round of monthly payouts. So, if you got some value out of this breakdown and you want to follow our journey, do us a huge favor. Give this a like and definitely subscribe for our monthly updates. Oh, and for you data nerds out there, we've dropped a link to the complete portfolio spreadsheet down in the comments section so you can really dig in. And one last time, always do your own research. So I'll leave you with this question. What's your favorite income play right now? Drop your go-to strategy or your top holding in the comments below. We genuinely love to see what's working for everyone else in the community. Thanks for tuning in.